Good afternoon. My name is Michael Lind. I'm the Policy Director of the Economic Growth Program and the Next Social Contract Initiative here at the New America Foundation. And I'd like to welcome you to hear Jeff Madrick, author of The Age of Greed, The Triumph of Finance and the Decline of America, 1970 to the present. So if you've wondered what historical or geological era you are living in, maybe we can provide some of the answer today. This is, all joking aside, we face the greatest crisis this nation has faced since the 1930s and 1940s. Increasingly there's a recognition that our problems did not begin with the crash of 2008, but they go back decades or a generation. And that's why we're very pleased to have Jeff Madrick here to help illuminate the historical roots of the present situation. Jeff Madrick is the editor of Challenge magazine, director of policy research at the Schwartz Center for Economic Policy Analysis at the New School in New York. He's a senior fellow of the Roosevelt Institute and the author of half a dozen books, including The Age of Greed. He's a former contributing economics columnist to the New York Times, a former Wall Street editor, Money Magazine, former finance editor, Business Week magazine, and he told me a former correspondent for NBC News. So I think we can just say he had a distinguished career in the former media. But please join me to welcome Jeff Madrick.
Michael, thank you very much.
No,
I'll go.
You sit there if you like.
It's easier for me to stand.
Okay.
If you all don't mind, I will stand. It's nice to see you all. Thanks so much for coming, especially insofar as this is a history book and not a book of the moment. When you write a longer book than usual and a book based on personalities, not so much a personality-driven book, but a book that presupposes that individuals created this history, you love it when people actually read it. History implies a story, not an economic thesis or two economic theses, and then a bunch of anecdotes and a touch of empirical evidence to prove your point. It suggests you should actually read the book. So I run into a well-known anchor from NBC who's no longer, who retired not too long ago. And he says, I'm doing this thing and I'd love to have lunch with you. I know I write a lot for the New York Review of Books, and I know you have a strong point. I read it in the New York Review of Books, strong views on the financial crisis. And I said, I have a copy of my book, ... I could give it to you. And he says, oh, no, don't worry about that. Well, just give me your card and I'll have the publicity people at Knopf send it to you. He said, now, let's just have lunch and just tell me the story over lunch. Well, this person has actually written a book or two, so I was surprised at that kind of remark. But the point is, I think to some degree, economics, you tend to dip into economics books or even political economy books. And I have a somewhat longer involved story to tell about the evolution of this history. One of the things I find when I taught, and I do teach, in fact, except for the photographer, I was reminded, I teach at Cooper Union, a school I'm quite proud of because it's a very high level education, very, very hard to get into, and tuition is free. So I'm dedicated to these guys. I have engineers, art students, and architects. That's what it specializes in. Engineers always sit in the back, and art students always sit in the front, so I assume you two are artists. It always strikes me as odd. In any case, this is a long book. Even so, I want to draw some conclusions like a good journalist right at the start, right in the lead. I don't want to let the lead go. History is created by individuals. It is not inevitable. This crisis was not an act of God, but it did not happen simply from between 2003 and 2008. It didn't even happen simply in the 1990s. First point, however, is individuals mattered. Individuals helped create it. Individuals could have stopped it. The damage that was done, an important point, and I think maybe the most important point I make in this book, the financial damage done through the misallocation of resources did not start in the 2000s or even the crazy period of the late 1990s. Damage has been done for 40 years because of a runaway financial financial community in which government abdicated its role as an overseer. Was there a cause of this crisis? I do get quite annoyed when I hear people saying it was a big cluster, fill in your four-letter word. Everybody did it. The other day, an economist and I were having lunch. An economist from Harvard, and he said it was, wholesale ignorance on the part of Wall Street. Don't buy it. The principal cause of this crisis was an abdication of authority and oversight and responsibility on the part of government. Greed, I am constantly told when I chose this title, greed always exists, I realize. But it festers and grows when it is unchecked, and we did not check it. One reason I call it the age of greed is that it deliberately reversed the lessons we learned in the progressive age, beginning in the 1930s. Literally speaking, historically, the progressive age, we say, began in the late 1800s. But the New Deal legislation was quite remarkably successful regarding finance. FDIC insurance, Regulation Q, SEC disclosure requirements. Those were reversed not merely in letter or partly in letter, and of course GlassSteagall and its attention to conflicts of interest. Those were reversed partly in letter, but most importantly in spirit. We reversed history in the last 40 years. We did it through the power of individuals seeking, for the most part, their own self-interest. People seem to think, and I brought up the kids at Cooper, but not only the kids at Cooper, people seem to think we'll just muddle through. I am often cautioned about being a little bit pessimistic. I'm known to be not very pessimistic, right, Michael, but a little bit pessimistic. We had problems before. We muddled through. America is great. History just flows. We will continue on. The history of America is not a matter of muddling through. It's a matter of solving problems periodically, not consistently. And solving those problems did not always result in just and lasting solutions. But solve those. Let me give you one example in early history. We keep talking about what a great growth there was in American history. But we delayed so long in making what used to be called improvements, a word that meant creating roads and canals in the early 1800s, advocated strongly by people like Calhoun in that period, resisted to some degree, to less of a degree than you might think, by Thomas Jefferson and others in his wake. We resisted a wholehearted effort to develop public investment in that period, and that probably slowed economic growth, even though we had economic growth in that period. That's just one example of a kind of misinterpretation that there is always progress, that we always basically solved our problems, that we solved them in time, and so forth. I had a little anecdote about slavery, but I'm going to pass it by. We've been right now we are muddling through big time. This is muddled through to the third or fourth power. Austerity economics is all the talk in D.C. It's only changing ever so slightly now as the economy starts slowing down. To me, it will be seen as one of the great historical follies of our modern history. It's very hard to believe that it dominates the language of both parties, that all the effort is being put on balancing the budget. It's an example of muddling through. It's one of many examples, and unless we change, it will leave a personal scar. Another troubling development I see is the resurrection of the idea that Fannie Mae and Freddie Mac did it all. Now, I thought this was laid to rest. Not that Fannie Mae and Freddie Mac didn't contribute to the financial crisis. Not that they weren't poorly created and organized organizations. But Wall Street created the large share of bad loans in America and resulted in the very large share of delinquencies in mortgage loans. Not Fannie, Freddie, and even some of the other agencies that created loans. And finally, there is this argument about tax cuts. Holy mackerel. Let me remind you about tax cuts. I haven't begun to talk about the book yet, by the way, in case nobody has noticed. Let me remind you, we had a really big tax cut at the start of the last decade, supported by Alan Greenspan, more or less wholeheartedly, though he rationalizes what he did. The Bush tax cuts. Between 2001 and 2007, despite war spending, we had the slowest GDP growth on record in the post-World War II history. I'm not counting the recession. Until the recession began, the recovery from trough to peak, slowest GDP growth in post-World War II history over any similar period after the great tax cuts. What are people talking about? What is Pawlenty talking about? Where is the darn evidence? Why does Feldstein go on and on? Goolsbee at least had the good grace to, Goolsbee was the great corrector of Feldstein's claim that the Clinton tax increase on upper income people would slow growth. Goolsbee pretty much put that to rest. I'm at the moment not a big fan of Goolsbee because this administration simply neglects the jobs crisis in America from my point of view. But why does this talk go on, and where the heck is the media? We just think we're going to muddle through. I think America is probably at the brink, but let me go back. Let me go back because I think this crisis began in the 1970s when two major historical changes occurred. I was getting out of school in the early 1970s. When I was in school, everybody believed stock prices would go up more or less 9 to 10% a year forever. There was a professor in one of my schools who always teased incoming naive students. Are you going to spend, some of these students had a little money, so they'd say, are you going to spend $5,000 on a car? I think then you could buy a car for $5,000. I'm probably wrong. Maybe it was $8,000. You know how much you're foregoing because you're not going to invest that in the stock market over the next 10 years? And I don't know, the number, it was $80,000, $90,000, and the class would collectively go ooh and ah. Of course, we were talking about the power of compound interest at the moment. Well, stock prices didn't rise. Stock prices didn't rise again until 1982. They didn't reach their old high. In fact, the Dow Jones Industrials, I think, hit 1,000 first in 1966 and then momentarily again in 1969 and didn't return to that level till the bull market around 1983. S&P 500 had a worse record. If you discounted stock prices, this doesn't include dividends. If you discounted stock prices by inflation, it didn't return to it. They didn't, on average, return to their old highs till 1992. Something was going on. Something changed radically. In the meantime, all kinds of new securities took their place. Basically, derivatives on currencies. Currencies were floated. Nixon basically unfixed the dollar to gold. In 1973, the major currencies were formally floated. Derivatives, trading derivatives on currencies became a hot issue. Interest rates started bobbing up and down with inflation. Derivatives on interest rates became very popular. On and on. Derivatives on commodities became more popular. Options, call and put options, were created and became very popular in this period. The nature of investing began to change. Stocks didn't work. Soon, a seat on one of the derivatives or options exchanges, I forget which, cost more than a seat on the New York Stock Exchange, I think as early as 1974 and 1975. That's how rapidly things changed. We had a broad change in the nature of investing in that period. What developed? Money market funds. Uninsured. FDIC insured our savings. Money market funds invested in Treasury securities, bank CDs that people never thought would run into risk. Money market funds were a major innovation in that period. And on it goes. I think when I started, there were 400 mutual funds. There are probably 10 or 20 times that many mutual funds. Then people actually used to invest in mutual funds. Now, of course, everyone only invests in hedge funds. But mutual funds were actually once a hot area to invest in. That's how much history changes. They're still actually the best place for most of us to invest. So we had this big change in the nature of investment. At the same time, we had what I consider an assault on government, and this maybe is the bigger change. And let me put this in some historical perspective. What caused it was the sudden turn, and of course what caused the change in the investment environment was the sudden rise of inflation and unemployment. One of the other shibboleths, one of the other great myths of when I was in school and continued onward was that we wouldn't have a serious recession again. We had learned to lick the business cycle. This is a late 1960s, early 70s piece of conventional wisdom that came out of the Walter Heller Kennedy years. Of course, we had the deepest recession, 73 to 75, of the post-World War II period, simultaneous with ongoing rapid and high inflation. This not merely confused the public, it was painful. Unemployment was high, and the price of the stuff you bought in the supermarket kept going up. Mortgage rates went up to 18%. I think I finally could afford to buy my first car in that period, and I think the interest rate I paid may have been as much as 20% a year. Imagine paying 1/5 of the car, the price of the car a year on interest, and I didn't even blink an eye. It was just the way things were. Now, there were lots of causes of this, and there are lots of myths about why it happened. But it led, in my view, it was the principal factor that led to an anti-government view about in America. In the 1960s, most opinion surveys showed Americans were very much in favor of what became the Johnson welfare state. And not only Social Security, but Medicare, war on poverty, so forth and so on. And even the civil rights legislation, though obviously that was the most sensitive. Here are the brackets of change, however. Obviously, the Vietnam War and lying about the Vietnam War led to lost faith in government. Watergate, on and on. But I think basically it was the economy. And as I say, here are the brackets. In 1972, Ronald Reagan was in his second term as governor of California. But he didn't think he had left a sufficient conservative legacy. He had and always had the presidency in mind, even back in the 68 conventions. He actually was a moderately effective governor of California because he did negotiate with the Democrats in office, and he did make some compromises. So he thought, he didn't really thought, but a man I talk about in the book named Louis Euler had this idea that you should cut state income taxes by virtue of a state constitutional amendment. They called it Proposition 1. Reagan loved the idea. A couple of his guys didn't love it. Most of them did. And he went out campaigning very hard to have Californians vote to cut their state income taxes permanently. Only could be changed by a supermajority in the legislatures. Milton Friedman got out of his hospital bed to campaign for this. He had had a heart attack at that time. Reagan lost soundly. Proposition 1 was defeated. Californians said, no, we don't want to cut our state income taxes. We think it's a little bit crazy. 5 years later, you know what happened. Proposition 13, 5 years later only. My wife sometimes tells me 5 years is more time than you think it is, which I guess is a suggestion about my age. But 5 years seems a little bit of time to me. 1978, Proposition 13, overwhelmingly voted for in California to cut property taxes, and it was the beginning of a nationwide tax revolt. 5 years, 73 to 78, 5 years in which Americans started to turn against government and thought that big government was the problem. It fit right in to a certain kind of ideology, the kind of ideology that the Louis Eulers of the world had had, that big government was always a threat to our freedom. And many of these people had anti-New Deal heritage. That is to say, they came from parents who had anti-New Deal heritage. Well, what happened? Along came business, and business filled a void. So did some think tanks. So did some rich people who financed think tanks. Walter Wriston is the first major player in my book. Sometimes people interview me these days and they say, and then you talk about this guy, a guy named, was it Walter Wriston, they say? Who is he? I never heard of Walter Wriston. Well, Walter Wriston was a household name back then. He was from First National City, and he built Citicorp. Walter Wriston led the assault on financial regulation in America. It did not happen in the 1990s or the 2000s. And the main target was Regulation Q. Now, Regulation Q was established in the Depression to keep banks from paying too much to savers, so then they wouldn't go gather all this money and chase wild and speculative investments in order to make more returns than they were paying savers. This was not a new idea. Adam Smith wrote about this in 1776. Don't let banks pay too much to savers. It'll create over-speculation. I keep meaning to write that down because I know you don't believe me that he really wrote this. Keep meaning to write down the citation and I forget. Well, Walter Wriston effectively got around this. He got around this, and this is an example. I have to tell you this example, even though it happened in the 1960s. Walter Wriston's kind of an interesting guy. He did come from a staunch anti-New Deal, anti-Roosevelt family. His father became president of Wesleyan, part of the anti-New Deal intellectual force in the nation at the time of Roosevelt. Wriston went against his wishes into banking. He didn't want to go into academia. He went into banking. And his first major client was a guy named Aristotle Onassis. Now, if people don't know who Wriston was, they probably really don't know who Onassis was. Probably to Americans, he's most famous for later marrying Jackie Kennedy. But Onassis, it was after World War II. Onassis said, and Onassis wooed Wriston because that's where the money was. Go to the banks. That's where the money is, right? He needed money to support his oil tankers. And he said to Wriston, the tradition is to lend me money against the resale value of these oil tankers. That's dumb. Let's do it against the money-making possibilities of these oil tankers. Lend me money against the charter value. Well, frankly, I think that makes some sense. So did Wriston. That was how Wriston launched his career. He's a smart guy. Some of it made sense. Some of it helped America get back on track and launch economic growth. But what happened in the 60s? He had to be able to raise more money for his bank. He had to be able to raise interest rates to attract money. So he created something called the negotiable certificate of deposit, in which he could pay high interest rates to big investors. But big investors would only climb aboard if they could resell those CDs in a market, like a stock market, like a regular treasury bond market. How would you do that? Well, we're not going to do that, they told Wriston, unless you guys create an aftermarket. Well, we can't create a market, so they went to a company called Discount Corporation. Discount Corp said, okay, we'll do the market, but you know what? We're only going to do the market if you, Citibank, finance the secondary market. Well, so this was self-dealing of the first order, right? Wriston's guys said to him, you know what, we better not go to the Fed. We have to go to the Fed to ask permission to do this. I mean, this is fairly outrageous. Wriston said, let's just do it, and then make the Fed stop us. That was Walter Wriston, and he did that time and again. The most interesting and most consequential thing he did in the mid-1970s was lead the pack in lending all those petrodollars, the Arab OPEC money. When they raised the price of oil, he lent that money aggressively to the third world, basically based on commodity prices, basically to South America. Now, why did he do that? To make the spread? Got a nice, handsome fee on every loan they made. In the 1980s, almost every one of those loans went bad when inflation got cut. The losses the banks had to carry were enormous. Mexico was going to go out of business. Volcker forced the banks by giving them public money to roll over some of their debt along with the IMF. That was the first bailout for the great free market, Walter Wriston. Walter Wriston preached free market ideology, cut down regulation after regulation, and his bank had to be bailed out at least major bailouts 3 times by the federal government. Always he rationalized that this was not a violation of free market principles. That's where the book begins. That set the stage. That set the stage for the gradual end of Glass-Steagall, which didn't happen merely in 1999. When Alan Greenspan became Fed chairman in 1987, or was it 86, I think, end of 86, he began to cut down the restrictions on investment banks on commercial banks for raising money right away. In 1996, he cut them down significantly, so the GlassSteagall no longer was a barrier between commercial banks and investment banks. The stories go on and on. Disclosure requirements began to fade away as these new derivative markets developed. In every decade had major misallocations of resources because, in my view, of the lack of government vigilance. We talked about the loans Riston made to the third world. Now, the government could have stepped in, by the way. Paul Volcker was interested in trying to step in back then, in fact. Even so were some of the Nixon and Ford appointees. But Riston acted so rapidly that they didn't really have time to organize themselves. And, of course, he had the ear of the more influential Nixon and Ford employees like Bill Simon, who had only utter contempt for the idea that government would interfere with this third world loan process. The 1980s, remember what happened. The S&Ls were deregulated. S&Ls were going out of business. So what should we do? Let's let them invest in anything they want to invest in with federal guarantees on their deposits. And let's let him make a lot of money to do so because it's a great capitalist incentive to do a great job. One bad investment after another. They had to be bailed out at the end of that decade. The LBO, leveraged buyouts and junk bond markets, flourished in that period. Michael Milken. I don't think a market quite like probably the derivatives market is like this. Michael Milken, if it had been in equities or traditional treasury bonds or anything, he could not have operated the way he did. Michael Milken was charged probably with lesser wrongdoing than he actually did. It's not quite clear what he actually did was against the law, but Michael Milken was buyer, seller, and middleman in junk bonds. He set the price. He took a piece of the action. He also often took a piece of the action surreptitiously, which was almost certainly against the law. He set the prices. He raised money for his clients and said, here's $150 million. You use $100, but use that $50 million to help me finance my next junk bond offering. Junk bonds became the main way of financing LBOs, but so did Walter Riston and the banks. The best evidence about the value of those hostile takeovers, which soared in volume in the 1980s, the best evidence showed that the large majority of them failed. The large majority of them failed. People paid much too much money for these companies, and these mergers, on average, did not work. But it made billionaires out of Henry Kravis and lots of other people along the way. The incentive was the fees they made. They made enormous fees. Volcker said maybe we shouldn't let them use loans to buy stock in these companies. Let's apply the margin requirements. That's one of the reasons Reagan didn't reappoint him. He could not also convince the Federal Reserve at the time. Volcker's not a complete hero in this book, by the way. I do think he panicked and created much too steep a recession in that period. But in any case, he's more of a hero than almost anybody else in the book. The 1990s were the most corrupt decade, I believe. Now, there's no easy way to assess this. The most corrupt decade in American financial history since the 1920s, almost certainly on a par with the 1920s. You say, come on, what kind of statement is that? Well, in the early part of the 1990s, we had a derivatives explosion led by not an investment bank, who you'd think would be writing the derivatives, but a commercial bank, Bankers Trust, because Greenspan and other guys didn't regulate them very closely. Bankers Trust induced people, companies like Procter & Gamble and Orange County of Southern California, to borrow enormous amounts of money in what was a far riskier trading scheme than they realized. And when Greenspan raised rates in 2004, that all came tumbling down. Orange County lost $1 billion. The guy who did it at Bankers Trust was fined $4 million for his efforts, or Bankers Trust itself was fined $4 million. That was the beginning. It was by no means the end. That's the period where one high-tech fantasy after another was floated by Wall Street. Why did they float it? Did they do it legally and above board? By no means did they. But one fantasy after another was bought in a market where it seemed like if you bought an initial public offering, you could sell it later at higher prices. And there's one said, well, who are the heroes in your book? You often get this question from the great moderates in America. There are some heroes, right? And you always think, well, the high-tech people are heroes. Well, of course the high-tech people are heroes. But high-technology executives participated in some pretty nasty schemes in the 1990s. So they're not all heroes by any means. And don't forget the backdating of stock option scandal, in which they led the way, actually, and some of the best-known names in the business were caught up. In any case, we had crazy prices and crazy amounts of wasted money put into these companies in the late 1990s. The reason it was corrupt, you could not keep a job in a major firm on Wall Street if you did not lie. It was as simple as that. You had to lie about the quality of those companies if you were an analyst. The bankers lied. The bankers set those initial public offering prices low. They gave shares to their executives. That was cheating the cheating the shareholders. The lawyers lied. The accountants lied. Accounting fraud after accounting fraud occurred in this period. It is a remarkable period, and yet it does not sit in the public consciousness as an era of corruption. Why is that? It's partly you write books to try and correct this a little bit, but it was a high era of corruption. Then we had, of course, WorldCom and Enron, which were the culmination of this corruption. I won't go into that, but it should be known that Citigroup and J.P. Morgan Chase were integrally involved with those two. And then, of course, we had the craziness of the mortgage markets in the 2000s, which, despite Citigroup being fined more than any other company in 2000 or 2001 and being the subject of more expensive civil litigation than any other company, participated fully and enthusiastically in the chicanery that led to the mortgage bubble, the housing bubble, the risky mortgages, and the collapse in that period. Now, I always said without question that the 1990s were the most corrupt decade, even compared to the 2000s. But as I look a little more closely at the activities of not merely the mortgage brokers, because we know they deceived home buyers, but as we look more closely at the securitizers, it becomes increasingly clear that people knew what they were doing. The CEOs always retain their plausible deniability in the great Ronald Reagan tradition, but I'm not even sure about the CEOs. But lots of people in these banks knew these products were bad, were far riskier than they were being represented as. They knew they were hiding assets. You know, one of the interesting things that comes out of the FCIC report is that Citigroup reported that its debt-to-equity ratio was 22, I think, in the beginning of 2007. Everybody said, well, you know, it's a bank. It's not too bad. The investment firms are up to 40 to 1, not 22 to 1. It turned out that when you include all the assets, these CDOs they hid on off-balance sheet, their debt-to-equity ratio was 48 to 1. Where were the regulators in this period? Why weren't they asking those questions? Of course, there was an ideology. I saw, I think it was Matt Taibbi traced it all to Ayn Rand. There's actually more truth to that argument than you might think. Alan Greenspan was a devotee of Ayn Rand. I don't know how much she influenced him, because I think he had this view always. He's kind of an interesting background himself in that way. His dad was his natural father was very pro-New Deal and actually wrote a book supporting Roosevelt. But his natural father went broke, left his mom, I think there was a lot of bitterness about that. And his mom's brother, more or less, didn't literally, but more or less became Greenspan's father figure. His mother's brother was a prosperous businessman and a political conservative. I'm not saying there's an exact and direct relationship there, but if I had to bet some money, I would. Ayn Rand was an extremist. If you don't forget her novels, read her political writings. She, too, of course, came out of the Soviet Union, where it was a little more understandable to hate government. But Alan Greenspan really carried the anti-government, pro-laissez-faire ideology to extremes. You know, in 1994, the government, the CBO, and even Jim Leach and some Republican congressmen wanted to finally to regulate the derivatives market. The Clinton administration, Arthur Levitt, I believe, and certainly Alan Greenspan would hear nothing of it. We all know about 1999 when those three men from the Wild West browbeat that unfortunate woman at the, Brooksley Bourne, who was merely first in her class at Stanford Law School and had no serious credentials compared to them, obviously, browbeat them into not regulating derivatives. But actually it went back to 1994. Instance after instance when Alan Greenspan could have intervened in the markets, in the mortgage markets, in the derivatives markets, over leverage issues, he refused to do so. He was rarely in the history of a calamity so major can blame be laid at the feet of a single man as it can be with Alan Greenspan. Not because he made it happen, but because he's the man who could have stopped it. Lots of other people I write about in this book made it happen, and it kept on going, and it is ongoing. I do want to say a little bit about this reforms now, because I think they're pretty much the financial reforms and whether they'll do the job. The Geithner Plan that was issued in June 2009, I think, was devoid of any serious intellectual framework for, and that was even with the help of the great Larry Summers, probably even at the direction of Larry Summers. It was really a finger in the dike approach. We have this problem, there's a hole in the dam, let's put a finger in there, let's put a finger in there, let's put a finger in there. There wasn't an overall intellectual analysis of what really happened. There was no serious analysis of conflicts of interest in major financial institutions. There was no serious analysis of the causes of over-speculation. No serious analysis of the ease of manipulation of markets, not merely through insider trading. I mean, what is Goldman Sachs but an information organization so big, knows everything not merely about the real economy, the so-called real economy, because it has so many clients there, but everything about who is trading what investment managers have what kinds of portfolios. Now, you remember the movie Inside Job, right, when the guy from AIG said, all I want is an unfair advantage. Well, all you want really was a job at Goldman Sachs. Now, Goldman Sachs, frankly, gets too much attention, because in my view, it was really Citigroup and Merrill who were the major culprits, who dove into that CDO market like crazy. So we've got a very big job ahead of us. We've got to analyze conflicts of interest in big banks. It's not that they are too big to fail. It's that other issue that people laughingly talk about. They are too big to exist. We've got to re-regulate along product lines where you are devoted, where these businesses are devoted to their customer and don't have a bunch of conflicting objectives in order to do their job. Is that going to be done? We've got to raise capital requirements to subdue speculation. Markets, and I think, in fact, Bob Shiller just admitted it in the New York Times column, no economist really forecast this financial crisis. I don't even think Rubini, who is a little bit, the stop clock is right twice a day kind of person. I mean, he did correctly analyze that there were huge piles of debt and it didn't seem sustainable. But I don't think he had any idea of the riskiness of the CDOs, which I think were first well explained in the book The Big Short, which I think probably was the best. To my surprise, I reviewed it for the New York Review of Books, I think was the best book about the crisis that there was. The economics business, economic theory did not at that time leave room for over-speculation and the damage it could be done. That's why we began to hear again about Hyman Minsky and Kindleberger and certain parts of certain aspects of Keynes' thinking. This reform plan is not really dealing with this. We really have to subdue speculation. Asymmetric, I'll just take a couple of minutes more. Asymmetric incentives on Wall Street. Are we really dealing with personal incentives? People were paid to take risk and were penalized only partially if the risk they took was wrong and they made losses? What kind of craziness is that? The conflicts of interest of the rating agencies? Here's for me, one of my final points is this. It wasn't merely financial ignorance that was widespread. It was economic ignorance, the ignorance of economists that was widespread. Even to this day, I think, maybe not until that Michael Lewis book made it imperative to look at CDOs, economists didn't bother to look into how fragile those CDOs really were. As Schiller said, Schiller predicted a housing crash. He told Schumer's committee, somebody on that committee told me, it would only affect the economy maybe 0.5% of GDP. He had no idea, and he's an honest guy. He will readily admit it. He had no idea it would bring the financial system toppling down. Economists just didn't know it. They didn't talk about it. I mean, you'll find a few nutty progressives who talked about it. But even they didn't do formal work on it. There was a wide range of economic ignorance there, I think. The point is, this financial community has, think about the crisis we had. We had crisis after crisis since the 1970s. Crisis after crisis. The 1973 crash, the 1982 market crash, the 1987 market crash, the third world debt problems, in the 1990s, the East Asian financial crisis, the long-term capital management crisis, the Russian crisis, only a few years later, the collapse of some $3 trillion in the stock market, the high technology market. How many crises do you want before you start saying, hey, it just wasn't 2007 and 2008? And all of that was wasted capital. So my final thought is this. We don't have to, the idea that we have to re-regulate the financial community to avoid the next crash is wrong. We have to re-regulate the financial community to get it to do what it's supposed to do, which is allocate capital to productive uses in America. And if the Obama administration and the Geithner Treasury had thought along those lines, they would have come up with a far more intellectually viable and meaningful reform plan. I'm going to leave it at that because, as you can tell, I can run on. And maybe we should allow you guys to ask some questions. I hope you have some. Thank you very much.
Yes, so we'll take questions. Please wait until the microphone is there. Yes, right up here.
Thanks. I'm Jed Schilling, retired from the World Bank, where I worked a lot on the debt crisis and a number of other things, and actually did a book in '95 predicting the Asian crisis, and all the other economists at the bank laughed at me. But wanted to make a couple.
And got a promotion. They all got promotions, probably.
Yeah. Yeah. That on the loans to the developing countries, the big international banks syndicated them and passed all the risk on to domestic banks, which is a precursor of the mortgage-backed securities, and laid that out. And I think the response to those crises convinced the banks that they were getting free public insurance, that any time they had a problem, they'd get bailed out, and the government wouldn't impose any regulations or other things on that. So we have now seen, and I appreciate your comments on the huge expansion of what I characterize as paper assets, where we have derivatives worth $600 trillion floating around and all of these other things. So what the financial sector is doing is producing and trading paper, collecting billions of dollars that they can spend on things, but not creating any real goods for the rest of the economy, which is one of the things that's really undermining the economy, is there's no reality corresponding to so much of the financial assets or the profits and incomes that so many people in the sector make. I'd like your comments on that and see.
Well, I think that's my central point. There's been a misallocation of capital. We haven't allocated capital to real goods, and it occurs repeatedly. You know, every instance, it seems, is used, like you used the 1982 crisis, as an example of moral hazard, the rise of moral hazard, which is to say banks had no discipline because they always knew they would be bailed out. The 1982 issue, the 1987 stock market crash, the bailing out of long-term capital management I read recently. But I don't buy that so much. I mean, we had market crashes all through the 1800s when there was nobody to bail people out. I think speculation, herd behavior, is a stronger animal. It's not as the implication of moral hazard is that herd behavior is rational, and I just don't think it's rational. But I do agree that it was basically paper shuffling in this period, and I think I tried to describe it with those third world loans where you got a fee. They got real money. The loans were based on commodities prices that could go up and down with the wind. The S&Ls invested in leisure time, you know, golf courses and resorts and all that kind of, and junk bonds, bought a lot of junk bonds. The junk bond takeovers at the LBOs at absurd prices. That was paper shuffling. Didn't create new assets, and on and on. The investments in fantasy high technology didn't create high technology companies. And then the investment in housing, which was driving up a fixed asset, much like investing, in effect, in a commodity, which would come down in price. So I completely agree with that. And I am aware that they were able to lay off that debt. Interestingly, Volcker, when he led the rescue of the banks in '82, did use the phrase "too big to fail," because it wasn't that there was that much bad debt around. It was indeed, well, I believe, concentrated. The losses would have been concentrated in a few banks, and he was worried about the banking industry coming apart.
Well, Jeff, I have a question. What is the role of mutual funds in our retirement system in the misallocation of resources? Let me just frame this by saying that if you look, for example, at Western Europe, the pre-retirement income equivalent in their public pension systems, their equivalent of Social Security, is about 60% on average. Here it's about 30% of pre-retirement income. It depends on your social class and so on. So Americans are much more dependent on tax-favored private savings for retirement, particularly middle class, upper middle class, 401ks, IRAs. This has created enormous pools of private investment capital that exist in the United States that do not exist in countries where it's more of transfer payments to retirees. And a lot of people have argued that the existence, and they've grown over time as they've accumulated pre-funded reserves, the existence of 401ks and IRAs has promoted a culture of short-termism in the corporate world because they're the ones buying and selling stocks. And a lot of us in this room, Robert Reich makes this point. In part, we, the citizens, are the problems because to the extent that we have 401ks, we want completely unrealistic rates of return compared to, we also want them from emerging markets or from Chinese factories. We don't necessarily, our 401k managers are not necessarily interested in investment in the U.S. Is that a factor?
Sorry. Let me just turn this on.
We'll now have a little
Somebody in
musical
Washington.
interlude.
I think somebody from the White House was calling. I'm not going to blame the people for this. I will blame the people for turning on government.
It's the system of private retirement savings looking for unrealistically high returns.
Well, I don't disagree with that, but I don't know. What is the beginning of that problem? The beginning of it is a notion that this tax-favored status of IRAs and 401ks, that we could just manage our own retirement by investing. The real reason that occurred, I believe, is after World War II, we had 2.5 decades of, it wasn't straight rapid increases in stock prices, but it was pretty consistent rapid increases in stock prices. And there was a remarkable overconfidence in how rapidly stock prices would go up. And I do believe Wall Street got that legislation passed. Again, we had that problem. You know, this is how short-sighted we are. After the bull market that began in the 1980s, then people started talking about privatizing Social Security and putting Social Security into the stock market, led by people like Pete Peterson, who are still active in this respect. And now Paul Ryan, even though the market, maybe only because the market was up by 30% in the last couple of years, talks about Medicare being managed somehow, privately. So I do think it's very short-sighted to think that we can manage our retirement plans through investment in these in the stock market. So I'm not so sure I disagree with that. I do think those mutual funds have enormous political clout. When you said it, I thought you were going to blame their managerial inabilities. But there are index funds and so forth where are pretty clever ways to manage your money. But generally, I agree with your point, Michael.
But just to follow up with that, you said the purpose of the financial system is to allocate capital to productive industry.
I left
in the
out
US,
the other purpose, but go ahead.
Right? But doesn't that clash if the purpose of these tax-favored savings is to maximize the retirement income of each of us, whether that is invested in the U.S. or not?
No,
is there a conflict of objectives?
I don't think there's a conflict of objectives. First of all, it's not a function. We don't put our retirement in there to get those returns out a year from now. We're banking on very long-term returns. We're banking on the capability of these people to invest in the long run and to invest wisely. I think the short-termism that I do think afflicted Wall Street came much more from attitudes about the takeover movement, attitudes about in the stock market about which stocks to push up, not merely from mutual funds, which stocks to buy, from the general course of investment over that time. The idea of giving CEOs stock options, the prevalence of this notion called efficient markets theory, that stock prices were actually rational and accurately reflected the future value. So I think the short-termism issue is not merely a function of 401ks. I think there are a lot of things that contribute to it. And one of them is economic ignorance, that idea of efficient markets. Markets are speculative animals that often are simply dead wrong, and public policy should deal with that.
So back there towards the door, a couple of questions.
Greg Squires from George Washington University and a previous contributor to Challenge. It seems to me that the distinction between government and private industry is often more apparent than real. The leadership at the Fed and Treasury and the staff at those agencies often come from and return to the private industry. So I'm wondering, what's your suggestion for dealing with regulatory capture and the revolving door if part of the problem has been regulatory failure?
Yeah, I think regulatory capture is an old issue on from both the right and the left, as you know. I mean, critics from both the right and the left. I haven't thought long and hard about reforms that would reduce that. I do think the regulatory capture of somebody like Greenspan was subtle. It wasn't like he was going to go off and get a great job like so many other people get. And I think, while I do think regulatory capture was a big deal, I think the gutting and basic denigration of regulation that began in the early 1980s with Ronald Reagan was a serious cultural phenomenon. It made it, unprestigious to have a job there. In Washington, you were kind of a fool to work hard. You only worked in order to get a job in the outside world. And I think it was to some degree supported by the ideology of the people at the time, which was anti-regulation, anti-tax, anti-government. I think all of that was a tragedy. I think that period I talk about in the 1970s, that assault on government, was a major tragedy in the history of America. And maybe I should have been clearer. It's not obvious to me we will recover from that. And that's what I meant by muddling through. We always think we're going to muddle through. It's not obvious we're going to muddle through after 40 years of this. Arthur Schlesinger Jr. always talked about the pendulum swinging back, and actually got that from his dad, who is a very prominent historian, senior. And I just don't believe that. I think that's just a misinterpretation of the way history works. We had to fight to get that pendulum back. And any idea that the pendulum swings back automatically, I think, is misplaced. And this period, I had the opportunity, because I had him as a professor and I got to know him when I was a journalist, John Kenneth Galbraith, to speak to him maybe 1 or 2 years before he died. And he had a long, I'm an admirer of his, but he had a long history. And I said, do you think we're going to come back? And he said, money talks so loudly now, I'm just not sure. I'm not just sure this country is going to work the way it used to. So the battle is even tougher. And I'm not sure we have, I tend to side with the Democrats, as you can tell. I'm not sure we have adequate Democratic leadership who fully understands what a tough battle this is and what a tough battle our history has been. I was on a show, an MSNBC show, and I'm talking a little bit like I'm talking now. It's going to be tough to fight back. And the guy says, well, Jeff, this is America. And he's kind of a left-wing guy. This is America, and we solve our problems. I mean, we solve the problem of slavery. And you just want to leap over the desk or at least give him a book. Because arguably we did not solve the problem of slavery even today.
Hi, I'm Dr. Caroline Poplin. I'm a physician. I'm your age. And I graduated from Yale Law School in 1973. So I went to law school with some interesting people. And I found the situation so dreadful that I left the Reagan EPA and became a physician, thinking I would at least get away from it myself. It seems to me that somehow it's important to get rid of conflicts of interest and all that. But there is so much more money to be made in finance. We have to make finance less profitable than people have to be comfortable getting an ordinary profit from an ordinary company. I see it in pharmaceuticals, where every pharmaceutical has to be a blockbuster drug, and if it's for a disease that not many people have, like epilepsy, then they have to sell it to everybody for something else until the patent runs out or the government steps in. Whereas there are basic medications that we absolutely need, including medications for cancer, for anesthesia, for antibiotics, that there are shortages of because it isn't, quote, profitable to manufacture them. I don't know whether you need to tax bankers or tax bank regulation or tax bank transactions, but somehow we've gone from a time in the 60s when a good, solid, reliable profit was enough to where, everything has to be a leveraged buyout.
Yeah, I generally agree with that. I think those are good comments. We need such a thorough overhaul in our thinking about how capitalist free markets work and how companies contribute to society. We've gone so far in the other direction that it sounds to most people absurd when you talk solid, practical common sense. To take one example, Wall Street is basically a monopoly or an oligopoly. Those they get $7 per $100 in fees when they issue an IPO, an initial public offering. It's an outrageous fee. They all charge the same thing. Nobody says, oh, I'll do it for $5, or at least, probably every once in a while that happens. Well, usually when you have a monopoly, that's a very strong case in conventional conservative economics for government intervention. Control those fees. I see nothing wrong, and this keeps me off of television shows and all this. I see nothing wrong with government starting to think about controlling the fees Wall Street talks about. You can't even get probably within 100 yards of the White House fence with a thought like that. I do think, and a very prominent investment banker agreed with me, after that crisis, there should have been an excess profits tax on Wall Street, just like there are excess profits taxes on oil companies. They didn't bounce back in 2009 through their own brilliance. You ever notice this about their own brilliance? We were brilliant, we deserved all this money, but we weren't blamed. We weren't the cause of the CDO problem, because who could understand CDOs? Not us. We couldn't. They're too complicated to understand. But in any case, an excess profits, they came back because of TARP and other programs. And the idea that TARP succeeded, it did succeed in calming the market for a couple of weeks. I'm glad it happened. I think there should be credit there. But they did not demand that, as you well know, bank lending continue be forced to continue. And they didn't get the returns they should have gotten. Everybody talks about how it didn't cost any money. When Warren Buffett invested in Goldman Sachs, I actually haven't done the numbers. I'm pretty sure I'm right about this. He got a much better return than the U.S. Treasury on basically the same risk, or probably even less risk. So I think we need a serious rethinking. We have monopoly after monopoly in our industries now, and it's pretty outrageous. I gave a talk in Boston the other day, and a guy at lunch, who I don't think was an economist of any kind or even a financial officer, said, they broke up AT&T into 8 different telephone companies and this and that. What did they do that for? You know how many companies we have today? 2. So it's a pretty big circle, pretty small circle, I guess.
My name is Elizabeth Brownstein. I'm a retired historian. In the spring, there seemed to be a good deal of hope coming out of Madison, for example, about the actions on the part of the workers there. Do you detect any sense anywhere in the country that the public at last is catching on and maybe something will happen to change this disastrous situation?
Yeah, I think the public was catching on in those circumstances. It's a pretty surreal country when people on serious television tell us teachers make too much money. That's what it's come to. But I don't think there's been adequate leadership I think probably indeed from the White House and frankly from the media and I don't think they've addressed it. I think a lot of the Washington press corps has what they think are great, deep, and profound interests, and I think they're rather narrow interests that don't reflect pain. I think a lot of the Tea Party anger is a consequence of economic pain. This is an argument people have been making for quite a long time, and it could be channeled to much more productive uses if we had some serious leadership, and we don't.
We'll take a couple more questions in sequence, and then you can answer okay. 2 or 3. Right over here.
Clay Ramsey, Program on International Policy Attitudes, University of Maryland. The question before last from the doctor was essentially about greed, and greed is part of your title, and I hope you don't walk away from that. And my question is, would it be possible to operationalize a greed index where the ground definition would be that the actions taken are imperiling the structure in which the actor is sitting? Could it be possible to pick out 3 or 4 publicly available statistics and combine them into an index and start to measure greed and say greed's going up, greed's going down, and link this to particular corporations.
Well, I
Commission for challenge.
I love the idea. I guess it would be size of houses, number of cars owned, size of CEO pay. I'm probably not going to devote attention to it, but I'd be all ears if somebody else did, and I would love to write about it. It's kind of an interesting idea. I think greed is a thing. It's the step beyond self-interest. And I think even when Ivan Bosi said greed is healthy, he was talking a little bit about Adam Smith's self-interest is healthy. But it's pretty clear, the idea that Wall Street tried to justify its income. Yeah, and let me remind everybody that financial sections of newspapers and financial newspapers also justified all that income. If I heard one more time that these were basically the best and the brightest, or the wealth creators. I love that. I saw somebody talk about how teachers are getting away with murder and don't work in the summers, and they go home at 3 o'clock, and it's Wall Street that creates jobs. And you go, where was this guy in 2008 when 8 million jobs disappeared in America?
Where was he in the 4th grade? One more question. Back here.
Merrill Guzno with the Fiscal Times. Jeff, I was curious why you didn't, I didn't, maybe you mentioned it, but it wasn't a focus. The shadow, what some people refer to as the shadow banking system. A lot of your focus seemed to be on the big banks. And the shadow banking system, we have this vast amount of private equity wealth now. We have the hedge funds that people talk about. And we really have our managerial class sort of rating our publicly traded companies, the productive assets you want to see capital allocated to, and becoming another gusher that goes into the private equity field, and then they are able to manipulate the sort of real economy from a very unregulated space. So I'm kind of curious what your thoughts about that as a sort of historical phenomenon in American history, what it's comparable to, and what might be an approach to somehow moving away from that kind of private system.
Well, there are attempts obviously, the investment banks, some of them have become banks. Some of the Dodd-Frank reform does cover, in fact, a lot of it does cover the former shadow banking system. There will be broad capital requirements and so forth. I think if they ever get derivatives onto a platform, an open platform, that will also cover a lot of the shadow banking system. I wasn't leaving it out deliberately. I was implicitly including it, but I think there's still a lot of gaps in it. First of all, we're not sure they ever will get derivatives on a transparent basis. It's quite remarkable. One of the more remarkable things for me, and I keep coming back to this economic ignorance, is look how Wall Street functioned. Derivatives were traded secretly and opaquely. Nobody knew what the prices were. And your point about $600 trillion in derivatives, I don't mind that so much because there should be offsetting trades. What we don't know is if any of the counterparties can keep their commitments. We should have some kind of capital requirements on those. We don't know if we're going to get there, but I think people have been thinking about it to some degree. But they sure haven't been thinking about hedge funds very much. I mean, except the insider trading. The insider trading prosecutions seem to be changing attitudes at hedge funds. But hedge fund investors should be protected, I think. It's kind of a joke that they're not. There should be a lot more disclosure. These funds have a lot of power in directing capital, as you point out. But I do think people are trying, the short answer is I do think people are trying to deal with the shadow committees, the shadow banking system, and I think it has to be included in any serious re-regulation of the system, especially in terms of making it transparent and reducing speculation. I do want to say this because maybe economists are my pet peeve. We had untransparent markets. We had conflicts of interest in ratings agencies. We had no insurance for savers. We had no disclosure requirements in many areas of the marketplace. And those are taking banking insurance aside, those are three basic principles of laissez-faire economic theory that were violated on Wall Street. Not progressive economic theory, laissez-faire and asymmetric incentives for people on Wall Street. Laissez-faire economists, which basically is the entire mainstream now in America, from Chicago to Rochester to MIT to Princeton and Yale. I now rank Harvard basically with Chicago and Rochester, not with, in terms on the political spectrum. But the mainstream economists should have been up in arms, including about the shadow banking system, not under any regulation. And they were nowhere to be found. They were, in fact, advocating ideas that basically supported other aspects of the system, like efficient markets theory, or like Milton Friedman's constant argument that competition would solve every problem, including prejudice in labor markets. And they weren't anywhere to be found. So, get angry at economists, too, because they really deserve it.
The book is The Age of Greed by Jeff Madrick. Please join me in thanking him.
Thank you. And I'd like to thank each of you, every one of you, for coming, because I know getting you to come to lunch, especially when no lunch is served, is
food for thought.
Very difficult. Thank you. Bye-bye.